It's a great pleasure hosting two of my very favorite voices of the global macro world today. Luke Gromen and Louis-Vincent Gall. Gentlemen, thanks for taking the time.
Thanks for having us, Ronnie.
We
Great to catch
are
up.
very proud supporters and subscribers of both of your services. We deeply value your insights, your forward-thinking analysis on markets, on currencies, on geopolitical shifts, on commodities, on asset allocation. And today we'll examine the state of the US dollar, the future of gold, the evolving impact of Bitcoin, and the broader shifts in the world economy. And I think basically no one else on this planet is better equipped to guide us through these really critical themes and topics that we're facing today. So it's a real pleasure. And I'm also joined by my dear friend Niko Jilch. He's a very renowned podcaster. And he used to be the author of our de-dollarization chapter in our In Gold We Trust report for many years. Niko, thanks for taking the time as well.
Hi guys, it's a pleasure.
So I have to say today is April the 7th, 2025. So quite a lot of things happened over the last couple of days. The so-called Liberation Day. And I'm sure that whenever you will listen to this interview, whenever you read the transcript of the report, perhaps in our In Gold We Trust report that will be published on May 15th, but I'm sure that quite a lot will have happened in the meantime. And therefore, we really want to take a step back and analyze the broader implications of what's currently going on. So let us start with the big elephant in the room, which is basically the US dollar being the reserve currency of the world. So I think it's perfectly normal for the reserve currency of the world to run a current account deficit with other countries. And basically, as we all know, there's just one big deficit, which is US with China. I think the rest is basically that's basically peanuts. So the big question from my point of view, with all those developments over the last couple of days and weeks, will the US really give up this exorbitant privilege? Will they give up the role of the US dollar of the world reserve currency? And taking a step back and analyzing really the big picture, gentlemen, do you think that the US dollar still will be the world reserve currency in 5 years? Who wants to go first?
Go for it, Luke.
I think it depends how you define it. Because when I get in these debates or these questions, it's one side says, look, it's still used in 90% of global transactions. It's still dominant, which is true. And then the other side, the side I tend to agree with, I hold up the dollar share of global FX reserves overall of just currencies, and it's gone from, call it 70% share to low 50% share over the last 15 years or so. And if you include gold into that at market price, the dollar share of global FX reserves is under 50% now. And so I think in terms of a usage, if that's how we want to define the debate, I think, yes, it absolutely will still be the primary or one of the primary reserve or used currencies in the world. But in terms of at the FX reserve level, I think in 5 years, the dollar's share of currencies, I think it's going to be below 50% at the reserve level. And I think when you add gold in there, I think it's going to be well under 50%, because I think what we are in the early stages of watching is a messy attempt to basically restructure the system in a way that gold runs the deficits, so to speak, instead of the United States. And there's huge executional risk and volatility associated with that. But that's where I see it going. So I think it's those nuances I think are important to kind of define and lay out.
So I don't disagree with anything that Luke just said, and which I know for the purpose of this conversation, I fear that Luke and I agree on a lot more than we disagree on. I just want to add something to what Luke said, and going back to your question on the reserve function. for me, one of the more important developments is that, if you look at the past 4 years, we've had 4 consecutive down years on U.S. Treasuries. And just as equity markets have really, been horrible this past week, U.S. Treasuries have really done nothing. For all intents and purposes, I think like the TLT is actually down today. If I'd been on a sailboat sailing around the world, and if all I'd had was the TLT price, I would think, oh, things are fine. I'm not missing anything. It's like up or down 1% a day. I'm like, sail on. Story. Nothing's happening in the markets. And I highlight this because I think what's happened in recent years is actually very important. Is that behind the U.S. dollar was always the U.S. Treasury market. And if you had excess dollars, if you were Saudi Arabia, China, Japan, whoever, if you had excess dollars, you bought U.S. Treasuries. In the past 4 or 5 years, that's no longer been the case. You had excess dollars, you didn't want to buy U.S. Treasuries. You didn't want to buy U.S. Treasuries for one of two reasons. Either you were afraid that they would get confiscated if you're a China, Russia, or essentially any non-democracy. Or you were just looking at the U.S. following extremely expansionary fiscal policies, even in the face of low unemployment. It's like, why would I own bonds when you're adding $2 trillion a year into the supply? I think what's happened in recent years is instead of owning treasuries, people abroad who had excess dollars decided, forget treasuries, I'm just going to buy the Mag 7. I can buy Microsoft, I can buy Apple, I can buy Google. They've got great liquidity. These are $2, $3 trillion companies. They're actually better than treasuries because they've got an inflation hedge embedded in them. I run a small business. We run everything on Microsoft. Every year, Microsoft hikes our prices by 15%, and every year we pay it because, we don't have much of a choice. So everybody decided, you know what, Mag 7, that's the new U.S. Treasuries. And I think this is the shift that is occurring right now, is people are realizing, okay, U.S. Treasuries are no good. Everybody agrees. But now all of a sudden there's a realization, hold on, is Mag 7 that great? They just spent hundreds of billions supposedly on AI where they were building themselves a moat, and that's going to be a massive write-off. They're about to get taxed not only by the U.S. administration, but by the foreigners as well as part of this new trade war. So their margins aren't going to be what I thought they were. So for me, that's the shift we're going through right now, is to have a reserve currency, you need to be backed by an asset that people want to own. Like if I'm going to save in dollar, you got to give me dollar assets that I want to own. I don't want to own treasuries, and I'm no longer that sure about Mag 7. Now you could say it doesn't matter. Well, the U.S. is great at coming up with the next thing. It'll be mortgage bonds. It will be, it'll be something. Like the U.S. makes stuff up. That's the U.S. comparative advantage. They're like the best financiers in the world. So you don't want Mag 7? Don't worry. We got something else sexy for you. There it is. I don't know what that something else is right now. I think treasuries are done. I think Mag 7 is done. So what's the next asset that's going to back up U.S. Treasuries? That's going to back up the U.S. dollar? Not convinced.
Luke, you said gold is going to run the deficit. Could you explain that? And does that tie into this? Is gold the next asset that's going to back up the dollar? And is this also the reason why we're talking about a Bitcoin reserve right now?
I think the way Louis framed it was it's a great lead into this, because you're seeing, for political reasons domestically here around the Trump administration and what they ran on and their electoral base, the steps taken by the Trump administration already year to date effectively told China, we don't want your money in the Mag 7 anymore, right? When we had this America First investment policy memo, February 21st, it's a significant paraphrasing, but it said, China, take your money and go home. We don't want to hear anymore. When you look at some of the proposals of the head of the Council of Economic Advisors, Stephen Myron, within that piece that he wrote, whatever it was, about the reordering the global trading system, something like that, whatever it was called, he talked about, and more importantly, this Trump America First investment policy memo explicitly discussed bringing back a tax on treasuries that China had been exempt from this whole time. And so you're talking about raising the cost of carry on treasuries. You're talking about raising the cost of carry on foreign capital. And for the U.S.'s purposes, by far and away, the biggest trade imbalance we have is with China. And so you're basically telling the actions of this administration have essentially been, to Louis' point, what is going to be the new next thing to sort of back the dollar. And the political side of it is we don't want foreigners buying our companies anymore. We don't want them buying our farmland anymore. We don't want them. They need to buy something else. And then I think additionally, curiously, within all of this trade war, there's one thing that didn't get tariffed in all this, and it was gold. The Trump administration made a point of not tariffing gold. And so if I just look at it as a straight relative comparative, I'm going to have cost to carry up significantly versus what it was on treasuries, on Mag 7, on stocks if I'm China or other U.S. trade creditors. And the cost to carry on gold in that context, nothing. And so what I think is being brought back on some level is something that was discussed in the 70s. You can find it in declassified State Department documents with Kissinger and Volcker and some of those types of folks, where they were having a similar problem, but the problem wasn't the Chinese buying up too much of America and Europe then. The problem were the Arabs, given what had happened to oil. And the proposal at that time floated by certain interests in the European community was that let them buy gold that floats in market at a market price. Basically recycle the petro surpluses into gold, drive gold prices up, and that way they have, and this is going to sound very familiar with what we're dealing with and what Louis just laid out, absolute national control over their reserves because the gold will be in their vaults in their country, inflation adjusting because it's gold, and prevents it prevents at the time, I think it was Kissinger or maybe it was Weintraub, said excess Arab ownership of Western industry. It's literally the exact same problem from a flows perspective that policymakers are trying to address today, at least as they see it as a problem. And so when I say gold will run the deficits, ultimately, I think what we're going to see is the price of gold. Basically, these flows that went into treasuries and then stopped and then went into Mag 7, I think we are in like pregame warm-up, not even in the first inning of these flows going into gold. And as they do, you're talking about trillions of flows into an asset that's, now it's up to a 20 trillion market cap, yes, but there's still only new flows of, $250 billion a year. So I think that when I say that's gold's going to run the deficits, gold's going to be the neutral reserve asset, in my opinion. That appears to me to be, away from what my opinion is, who cares, but what the Trump administration appears to be attempting to construct are a set of incentives to redirect foreign capital that first went to treasuries and then to Mag 7, as Louis noted, into gold going forward.
So what's currently happening? That's basically like, it sounds a little bit like the wet dream for every gold bug. I mean, there's Luke Gromen now talking to Tucker Carlson about gold and explaining him actually what gold means. We've got Scott Bessent saying that he's actually a gold bug.
Yeah, look, you're right. It does seem to be a wet dream. And yes, when you start to see everything in the general media, then you get, indeed to the question that Luke raised, are we in the warm-up phase? Are we in the fifth inning? Are we in the ninth inning? I think the challenge today, if you're a gold investor, is the very question we're discussing, and it's whether it's different this time. Because if you take a step back, you think, okay, gold relative to pretty much every commodity, whether energy, whether copper, whether silver, whether anything, gold today is expensive. Gold relative to average hourly earnings in the United States, or the price of U.S. real estate, and gold is at the upper band of its historical, trading zones against pretty much anything you care to look at. And so, yes, at this stage, to get fired up about gold here, you have to make the argument it's different this time. Now, there's a lot of reasons to think that it is different this time. Don't get me wrong. of course, anybody who's a seasoned investor, when you see a very stretched valuation and you're like, oh, don't worry about it, it's different this time. It reminds you of a lot of, it's like, oh, that reminds me NASDAQ 2000, or it reminds me, frankly, AI just like 10 minutes ago. It's like, oh yeah, don't worry, like, yeah, buy NVIDIA at 50 times sales. It's like AI is going to change the world. Don't worry about it. And so I think as gold investors, and all of us here have been bullish gold, we have to acknowledge, okay, valuations are getting stretched. So here it really depends on the fundamental environment changing, the global fundamental environment changing. Now, I do fundamentally believe that today, if you are a foreigner and you've got a bunch of US dollars, and for years these US dollars were either going into US Treasuries or US equities, and that was great, and that did fine. Then US Treasuries stopped working, and now US equities are not working. And now I'm like, okay, what do I do with these dollars? Now, one option indeed is, what, world is really uncertain place. I don't know what I'm going to do. I'm just going to buy gold. And I think that's what people in China have been doing. That's what people in across the Middle East have been doing, and India and lots of places. There is, of course, the alternative. It's like, what? My local assets are actually really attractively valued now. If I'm a rich Chinese guy, real estate affordability in China is today at a 25-year high. Real estate has never been this affordable. Prices have come down. Mortgage rates have collapsed. There's been no new supply for 5 years. So maybe I'm like, you know what? Maybe this is worth a punt. Or if I'm a rich Middle Eastern guy, maybe I'm like, okay, European stocks are cheap and Chinese stocks are cheap and so on and so forth. So there is no doubt that, the overall willingness of people to stay in the US is probably decelerating very, very fast. And this is not a political statement. It's just a reality. If you're a foreigner and you're looking at the US, you think, what a dumpster fire. And what am I going to do with all these dollars? And do I still feel comfortable owning stocks in the US that are, at the end of the day, very expensive relative to stocks anywhere else? So yes, maybe I shift them to gold. Maybe I'll move to stocks outside the US. Maybe I'll move to real estate outside the US. There are other alternatives to gold, but gold is up there.
After, Luke, you talked about this discussion in the 70s, right, with Kissinger. I highly doubt that anybody in the US administration has read any transcript from that time, but basically, do people still know when it comes to governments and central banks, do people still understand what gold really is, or what role gold could play? Because last time I checked, it was a tradition, I think. Powell called it a tradition, or was it Bernanke? And I get the guys confused, but you know what I mean, right?
I think there is. Yeah, I do think there is still at a certain level an understanding of what it is and how it can be used. I do believe that, and I've in various conversations gotten certain levels of confirmation or comfort around that.
And
Louis, maybe can you give us the perspective from China?
Yeah, look, I was about to jump in after Luke said this. When Russia was kicked out of both the US dollar, the euro, the Swiss franc, etc., obviously its trade with China went through the roof, and essentially, everything that Europe used to export to Russia, be it machine tools, be it cars, tractors, you name it, is now being exported by China. And, to the point of, do people still know what purpose gold serves? A lot of that gold ends up being settled in gold. A lot of that trade ends up being settled in gold. So if they had forgotten, if they hadn't read the Kissinger papers, if they truly believed that by imposing financial sanctions on Russia, they would turn the ruble into rubble, and that they would, absolutely collapse the Russian economy because, lo and behold, it didn't have access to dollars, then I think they've just been reminded that actually, if you have gold, you can settle your trade. You can buy stuff from abroad. You can, gold does flow across borders pretty easily. You can move a lot of wealth around in not too much space. And it allows trade to flow. So in case they had forgotten, to answer your question, the past 2 or 3 years of Russian sanctions just reminded them.
Mm-hmm.
Yeah.
Gentlemen, one major topic that has changed over the last couple of days. I think on Wednesday when the tariffs were announced, everybody thought, okay, well, we're having some sort of a further recalibration of portfolios, so we'll move assets out of the US into Europe. But then I think over the next 2 days, it basically changed because markets started to price in a recession, a US recession, but actually, I would say to some degree also basically a global recession. Now, the big question is, back in the days, we always said if the US sneezes, the whole world will catch a cold. And now, Louis, you have got a very, very pronounced view on that, how less dependent China is on the US anymore. Would you say that we could see a US recession without moving into a global recession? Is that actually possible?
Well, it depends how bad the recession is in
Yeah.
the U.S., of course. And if it's a fairly shallow recession, then yes, it's absolutely possible. Look, right now the U.S. is trying to do at the same time fiscal consolidation, which arguably was very necessary, but it's going through saying, look, we're going to do fiscal consolidation, and we're going to massively rearrange our trade relationships, which essentially is saying, look, we're going to crush the U.S. consumer, because saying we're going to move back into reduce our trade deficits is saying that we're going to put the squeeze on what is 70% of our economy. And so when you look at it this way, you have to think that's quite a recession. Like fiscal tightening at the same time as putting the squeeze on the U.S. consumer, that's probably quite a recession. Now you could say what's quite unusual about this one is that it's almost self-inflicted, right? It's like it's a policy choice by the United States to go down this road, somewhat similar, frankly, to what China did between 2018 and 2024. 2018 to 2024. Once the U.S. said we're going to put restrictions on exports of semiconductors to China, China said, okay, fine. From now on, no lending to the consumer, no lending to real estate. All the money goes into building up industry, because the U.S. is trying to take us down. Today it's semiconductors. Tomorrow it could be auto parts. It could be chemical products. We have to be self-sufficient in everything. So all the money we have is going to go into industry. Now, essentially, this led to a collapse in Chinese growth. It definitely led to a collapse in real estate. It led to a collapse in Chinese growth. Sure, they reported 4 or 5% GDP growth, etc. But underneath that, you had a collapse in consumption. Underneath that, you had the collapse in real estate. You had huge write-offs at the banks. It was a period of pain. But China's trade surplus did move from $200 billion to $1.1 trillion. Now, when you look at what the U.S. is proposing, is essentially what China did back then. Now, China did this, and there wasn't a recession in the rest of the world, even though it's the second biggest economy in the world. It didn't unleash a recession onto everybody else. Sure, if you were a commodity producer, it wasn't much fun. If you were dependent on luxury sales into China, if you were LVMH, etc., it wasn't much fun. But if you were Hong Kong, dependent on Chinese tourism, that wasn't fun at all. But China went through it, and now China's entering into a different phase. If the U.S. proposes to go down this path, yeah, I think it's going to be pretty tough for everybody, because in recent years, so many businesses around the world, countries, etc., have just grown accustomed to the idea that the U.S. consumer was 70% of GDP, and that you just sold to the U.S. consumer almost regardless of what happened. So if the U.S. really is now saying, look, we're going to crush the U.S. consumer. We're going to build our own industry. I'm very skeptical of their ability to do it, both politically and just physically of the ability to do it. But if that's really the path of policy, then what does that mean for if you're a European, Mexican, Chinese industrial and you've spent the past 20 years used to selling to the U.S. consumer? Now, not only are you going to lose that client, but you're going to gain a competitor. That doesn't seem like a super great recipe for growth, for investment, for risk-taking from the private sector anywhere in the world.
I mean, sorry, Niko, just one more question. I mean, so far, so good, one could say, because treasury yields are down, the US dollar is down big time, and the price of oil is down, of course. I mean,
I think not that much, though. I mean, sorry to interrupt you, Ronnie. Sorry to interrupt you, but are you rushing out to borrow money now that bond yields have come down?
No,
30,
but I think
points?
I agree. I think that's kind of cherry picking by Scott Bessent, and I would say like this detox period that he was referring to. I mean, it sounds great, but it's like if the I don't know, the heroin addict that also has a cocaine and alcohol problem and a gambling addiction says, okay, I'll stop it now. I'm becoming Ironman doing vegan now. I mean, it sounds not very, very realistic from my point of view. But the question from my point of view is, when will the pressure from markets be actually too big, and the pressure on the Federal Reserve? Because Trump was very quick putting some pressure on Mr. Powell, and Powell said, well, no, not going to happen. And I think the next Fed meeting is on the 7th of May. But the big question for me is really this pressure that has built up over the last couple of days. Do they really have the stamina to say, okay, we'll work through this. We don't care about markets. We don't care about equity markets. We don't care about, what's currently probably happening in private equity, in debt markets. We've seen corporate spreads blowing out. I just don't really see that. So I think it sounds great in theory, but in practice, I don't know. Look, what would you say?
Yeah, I think the executional risk is the huge part of the risk, and they're almost between two trapezes, where they're kind of letting go of the trapeze of the old world and flying towards the next one on the come. And the challenge, China was able to do this, and they still had however many hundreds of billions of dollars a year coming in from, as Louis said, their trade surplus in that time went from 200-something billion to $1 trillion plus. Right? So you've got capital flowing in throughout that whole process for them. The United States has 120% debt to GDP. The deficit is what it is. It is an economy, as we've shown in our work, that is highly, highly sensitive to stock prices. Stock prices go down, receipts are going to fall. And your interest and interest-like obligations in the United States that is gross interest expense plus entitlements plus Veterans Affairs. They are 108% of all-time high receipts already as a starting point. And now receipts are going to fall pretty sharply in the next 6 months with just what stocks have done. If stocks stop falling today on April 7th, your receipts are going to be down in all likelihood by 5 to 8% by later this summer. And so my point in highlighting this is I agree with Louis that the U.S. appears to be trying to do what China did, but they're trying to do it from the diametrically opposite capital flow position. At the same time, they're effectively scaring the capital they need out of the U.S. markets. And so I think as we sit here April 7th, I think we are weeks at most, maybe days from the markets basically calling their bluff. And what I mean by calling their bluff, I think the unthinkable is suddenly very thinkable in the United States, which is an emerging market like sudden stop crisis. And you arguably, as we sit here today, April 7th, 10-year Treasury yield was 3.9% when I went to bed with stocks down big. And I wake up and the 10-year Treasury yield's flat. And now I jumped on this call, 10-year Treasury yield's up 15 basis points. So Scott Bessent and Trump have, since February 26th, knocked the S&P down by about 18%. That's, I don't know, 10 trillion, 11 trillion in wealth out of the stock market. And they got 12 basis points since February 26th. 12 basis points. And I think it's very possible by the end of this week, they will have gotten 0 basis points with even more stock declines. And by next week, they will have rates up with even more stock declines. And then what do? Does the Fed come in and cap yields? Because
can I hop in here? Because I think
please.
I think one important point is that one of the reasons I think Bessent has been so laser-like focused on getting yields down was perhaps not as much the massive amounts of debt that the U.S. government has to roll over, although that's part of it, but U.S. corporates have amazing amount of debt as well. Because remember that in the second half of 2020 and the first half of 2021, you had record debt issuance by U.S. corporates. Because back then, you're just post-COVID, you're reopening, interest rates are at 0. If you're the CFO of a listed company or even a private company, if the market's going to give you free money, it'd be criminal for you not to take it. And they all did. They all took the money. You look at the corporate debt issuance, it went absolutely through the roof. And what did they do with that money? Did they build a bunch of factories that would allow them to pay back the money in 5 years from now? Because in the US, when you issue debt, it's five-year paper. What did they do with that money? They all bought back shares, like in spades. Fast forward 5 years, i.e. right now, and you're looking in the second half of 25, first half of 26, at record high corporate debt rollover. And I think that's why they've been, the administration is like, we got to get yields down. Because if you don't, when you, roll over paper in which you paid 1 and now you're paying 6, then you're going to cut your capital spending, you're going to cut your employment and to make sure you pay your debts. And all of a sudden you're looking at a recession just in time for the midterms. So I think that was the game plan. It was like, let's get yields down, roll over all the debt. Once the debt is rolled over, we cut taxes and we goose up the economy just in time for the election. Now, this scenario is now going wrong bigly. It's going wrong bigly because instead, yes, Luke points out, you've lost 12 basis points on the 10-year. Okay, sweet. On the flip side, you've got spreads that have grown by 40 basis points. So you're now in a scenario where actually the debt rollover costs, instead of going down for your corporates, is actually going up. And the more the economy slows, the more that's going to be the case. And so it starts feeding upon itself, which again is where we are today, and is an extremely, and that's another difference between what China did 6 years ago to where the U.S. is now. In that, in China, you don't have much of a corporate debt market. You have a little bit of it, but most of the corporations fund themselves on bank credit. And so as China was going through this transition of saying, look, for the next 5 years, all we're doing is industry, the banks, were told, central bank cut interest rates, and the banks were told, you're lending at this price to these guys. This is, of course, how, it's a different system. The U.S., doesn't have that luxury. Trump can't turn around to JP Morgan and tell Citibank, hey, roll over the debt for all these guys at that price, because otherwise our economy is going to implode. It's just not the way the U.S. works. So, yeah, I do think that, there was a game plan, and it's gone wrong. And instead now, the U.S. is stuck in this tit for tat with China. And the big question mark every investor now has is, hold on, is it China that's going to be isolated, or is it the U.S. that's going to be isolated? They're raising tariffs on each other. Who is actually more vulnerable now? Now, the market's perception is, of course, China's more vulnerable, and of course the U.S. isn't. But if bond yields start to rise in the U.S., And by the way, as bond yields start to rise, what do you think China does with its $1 trillion of treasuries? Does it, and as the trade war keeps getting worse, does China say, oh yeah, look, ship me in some more treasuries? Or do they call JP Morgan and say, hey, what's the price for 100 billion? Okay, yeah, yours done. What's the price for the next 100 billion? Yep, yours done. And so, what are the odds of that scenario happening? I think the odds of that scenario are decently high.
I think and Louis, to build on that, something that hit me over the weekend, I was thinking about it was, what I'd been very vocal advocating is that, look, there's an order of operations that must be respected if the U.S. is going to try to restructure in the manner that you highlighted earlier, Louis, which is you got to devalue the debt first if you're going to do this. And they didn't. And so now because they didn't, to Louis' point, this is like an MMA fight where one fighter knows the other fighter has badly broken ribs. What is he going to do? He is going to beat on those ribs until they submit. And that's the ribs, and the broken ribs of this case is the debt for the U.S., which is it's going to feed on itself. And sort of everybody in the markets knows that. And so, people that manage books to monthly or quarterly, there's no national interest there. All they care about is their job. And if the market starts going against them, they're going to start trading with the Chinese on that. They will start selling. And so they're in the U.S. administration's in a very delicate situation because, for whatever reason, I understand the political difficulty in doing so and some of the mechanical difficulties, if not impossibilities, but they needed to devalue the debt first before you tried to do this. And they didn't. And so now they're in real trouble. And I something we were talking about before we jumped on this weekend that I think further accelerates. And to me, the market isn't weighting appropriately relative to Louis' point around who's got the leverage at this point. China just put export controls on rare earths on Friday. And then on Sunday came out and said, we won't interrupt any flows to anybody that doesn't side with the U.S. against us. But we're only going to do this in the interest of peace and stability, which, I reached out to some friends of mine in China. I said, this sounds like this is the Chinese way of saying we're cutting off rare earth shipments to the United States military. And I said, yeah, that's probably a pretty fair interpretation. So now things are getting really intense because, if you side with the U.S., if you're Japan, and we've seen some highlights around Vietnam and Japan, hey, we want a trade deal. EU, they want a trade deal. Great. Without rare earths, the only thing Japan can send me is a TV box that doesn't work, a computer that doesn't work. We can't send missiles to the Europeans, not without rare earths. So, what are we with China sharing? So there's this intense understanding from what I'm watching that the Chinese understand leverage points and on the second derivative and third derivative, in my opinion, far better than U.S. policymakers and a lot of U.S. investors. And so it sets up for, the math on the debt side is what the math on the debt side is, and it is going against the U.S. fast. And now you've got it on the trade side and in the real world goods side and the geopolitical side going, I don't know if it's outright going against the U.S. yet, but it is certainly going against what overriding consensus about how this is going for the U.S.
So if we say there's this MMA fight, China versus the U.S., China's strategy would basically be to stand firm, to resist, and just wait for Trump's strategy to collapse. And it seems that actually China has a little bit more of an economic resilience because now they are actually facing more of a deflationary environment currently. But the US might be facing a stagflationary development. Would you agree to that?
I definitely agree. And look, China's been getting ready for this fight for the past 8 years. That's the truth. When the US said no more semiconductors to China, I've already said this, but it was a super important moment for China. This was when China decided, okay, we're at economic war with the US. They've just fired the first salvo. Now we get ready. Now, I don't think the U.S. perceived it in that way, but in China, it was very much perceived in that way. And it was like, okay, we got to get self-sufficient in everything. We have to control every single industrial vertical, etc. The U.S. didn't do this. To Luke's point, once you told China, no more semiconductors, the U.S. should have said, let's spend a lot of money building up our own rare earths in Nevada or in Idaho or wherever, or in Canada, wherever you can like find rare earths, because there are some all over the North American continent and in Australia. So the U.S. at that point should have said, okay, we're now in economic war, but the U.S. didn't. China did, the U.S. did not. And so that's the situation we're in right now. Now, I think let's take a step back and also look at the leadership that you have in both countries. Now, Xi Jinping is a guy who would have spent 5 years during the Cultural Revolution digging the earth with his bare hands in order to survive. He would have seen his friends, siblings, etc., literally starve to death. He's gone through a level of hardship that none of us on this call can even begin to understand or comprehend. So I highlight this because I think that entire generation of leaders in China today is capable, that did go through the Cultural Revolution. That was a horrible, horrible period. They're capable of taking a lot more pain than any of us. And now you could say that might be them, but the Chinese population is soft. The Chinese population won't be willing to take much pain, etc. But this is where it gets interesting, is the Chinese population has been taking pain for the past 5 years. They've had their real estate prices drop 30%. They've had no wage increases for the past 5 or 6 years. They've already taken in some adjustment in a way that the U.S. just hasn't. I think obviously they're now at each other's throats, and the worst setup, in any kind of negotiation, when you do a business deal or something, the worst setup is always when you think the other guy is weaker than he really is. That's the worst setup, because when you think you have all the cards and you think the other guy is weak, that's not a good setup to get a deal done. And right now, for the past 5 to 10 years, all the media in the United States, and I keep writing about this, they keep saying, "Oh, China's about to collapse. It's this house of cards. It's like you flick it and the whole thing is going to implode. It's on the verge of revolution, etc., etc." Now, this whole media push of China is weak, it's about to implode, is so far from reality. You go to China today, you feel like this is where the future is being built. They've got flying cars. They got trains that go 450 kilometers. They've got 6G telecoms. It's like literally the engineering discoveries are all happening over there now. But the perception is China's about to implode. Meanwhile, and if you go to China, their perception is the U.S. has zero tolerance for pain. The U.S. is fundamentally, just about having a good time. And which I'm not sure is true either, by the way. I'm not sure it's true either. I think there's the tolerance for pain in the U.S. is actually quite high. The U.S. is fundamentally a warrior nation. So all this to say that I look at it, both sides completely overestimate the other guy's weakness and underestimate the other guy's strength, which, it's a terrible setup. It's a terrible setup for any kind of compromises.
One thing, guys, that is completely baffling is that we have the world's superpower basically trying to inflict this pain on itself. And the story that, we hear in Europe is, Trump is crazy, Musk is crazy, everybody's crazy. At the same time, we know it's working to some degree, because even in Europe now, we come to the table, we do deals. The EU is taking back its own laws and it's calling it regulation, which is funny that nobody's really recognizing this, but it's happening on a daily basis now. So it's working in some way. So I would like your diagnosis of what their point of view is. What are they really doing? Are they trying to basically, let the air out of the stock market before it can collapse, and then maybe try to collapse the yuan first, China first? Is that the MMA game that we're playing here?
I think so, and I think the levels of pain tolerance in the U.S. are sort of bifurcated in the same way our society's been bifurcated. We've got the 1%, we've got everybody else based on the policies of the last 30, 40, 50 years. And, so what's interesting is, we just had a famous billionaire come out on Thursday and say, hey, the best negotiations happen when, the other party thinks you're crazy. So this might work great. And like 3 days later, that same billionaire is like, hey, whoa, maybe we need to pause tariffs for 90 days, right? Like, so like his pain tolerance was like exactly 72 hours. You come out to flyover country and
I think you mean 10% on the S&P. More than 3 days. The
right,
pain
exactly,
tolerance
right?
is 10% on the S&P.
Yeah, exactly. And so like for the 1%, I think that's their pain tolerance, and spreads blow out. And I think there's for sort of flyover country, bottom 50%, and Louis, you and I have been out here in Cleveland before together. Like, you go to enough funerals for 18-year-olds that have died of fentanyl overdoses, and there have been 1 million people dead in this country of drug overdoses alone. And then you factor in suicides, you factor in alcoholism. The death rate per 100,000 of middle-aged Americans is not that far below the death rate of Russian men in the 1990s. And this is not understood in Europe at all. I was there last summer. People kind of asking me ahead of the election, what's going on? Why do you Americans like Trump so much? Because everyone in Europe, and at least in the part I was in, Trump bad. And I said, listen, here's what's going on. And when I tell people that the death rate amongst middle-aged American men and particularly white men and African-American men is near where it was in Russia in the 1990s, they go, wait, what? In America? I'm like, oh yeah. So that part of America, we're in sort of like from the Good Will Hunting, right? When the dad sets down, the belt, the stick, and the wrench, and Robin Williams says, oh, in that case, I got to go with the belt. And Good Will Hunting's like, I always took the wrench because F him, that's why. So there's like this bifurcated level of pain tolerance in this country around what's happening, where I think the 1%'s like, oh my God, enough, uncle. And the rest of the country's, the bottom 50%'s like, burn it down, take the S&P down another 10. And like they know, some of them know, that look, if the S&P goes down another 10, 20, 30 from here, they're going to start getting layoffs. And if tariffs go up, they're going to get layoffs. You're already seeing it in Michigan. But that's, I think, to Louis' point, a miscalculation where these people are like, I got nothing to lose. Burn it down. Don't care. And so it sets up, to Louis' point, this very dangerous situation because half this country, like, hey, burn it down. We've had 1 million people die of overdoses alone in the last 15 years. Like, how much worse can it get? The answer, of course, it can get worse, but there's this bifurcated pain tolerance in the U.S. And critically, the pain tolerance side, the side with the higher pain tolerance, is Trump's base.
I think that's such an important point by Luke, because that's the same split that you saw during the Brexit vote in the UK, the politicians were going around like the whole Project Fear during Brexit was, we're going to tell people that, they're going to lose this and they're going to lose that, etc. And the Brexit voters would say, you know what, I've lost everything already. Like I've lost already, like what do I care at this stage? And so, yes, I think our societies are bifurcated that way. And look, in this U.S.-China trade war that is now full on, especially after the imposition of another 50% today by Trump, it's the global perception at this stage is that Trump is the aggressor. Now, I actually think, I don't know if that is a fair assessment, actually, because, you could say, well, China manipulated its currency for years, and China's running a 1.1 trillion trade surplus, which is ridiculous, et cetera, et cetera. So, but nonetheless, the perception is the trade war was started, Trump is the aggressor. Now, in any military conflict, it's always easier to play defense than to play offense. Playing defense, like when you're playing offense, it's hard. You're the one who needs to move forward, because if you're not moving forward, essentially you're losing. If you're not getting victories, defense, all you have to do is hold your line. And so, right now, Trump is playing offense on trade. If he doesn't get some big victories, then what is it all worth for? What's the point? And then you ask yourself, what do the victories look like? Now you could say, well, look, Zimbabwe this weekend said they were getting rid of all tariffs. Okay, great. Here's a victory. But deep down, the victories, again, what do they look like? And why is Trump doing this? I think he's doing this because the welfare state as it's built no longer works, partly because the apples of this world essentially can decide their tax rate. It's like, oh, we'll book all our profits in Ireland. We'll do all the manufacturing in China, book the profits in Ireland, and pay no taxes. And then Google does the same thing, and then Facebook does the same thing, etc. And a few years down the road, you end up with your industrial workers, to Luke's point, dying of fentanyl overdoses, and a welfare state that is now completely blown out of the water. So a win for Trump is for this to stop. Now, whether this is going to occur in the next year or two, I guess seems unlikely to me.
Yeah, and that's a challenge, right? Because when I talked about the two trapezes before, the interest doesn't sleep, right? So ultimately, the federal interest doesn't sleep, the corporate interest doesn't sleep. So they are working against something that is not just never sleeps, but it's enormous as a share of the economy, as a percent of GDP. And so that's why it was so critical to devalue the debt first, because then you buy yourself time. And there's ways they could still do that in terms of revaluing gold, things like that, to buy themselves some time. But the way they have executed it, I think Louis is exactly right. Play defense. If I'm China, I thought it was a very underreported story a few weeks ago. Walmart went to China. And, our media in the West reported that Walmart was dressed down. But one of the fundamental underpinnings of this whole tariff new trade war was it's going to go like it did last time. And we're going to go over there and we're going to put tariffs on China, and our companies are going to go over there and they're going to demand relief so that the U.S. corporate profit margins won't get hit or consumers won't pay more. And to Louis' point, the world changed. Walmart went over there and was basically told, bug off. And so you eat the tariff, or you pass it on to your consumers. That was not how this was supposed to go. And so as we sit here today with Trump having just raised another 50, now you're looking at a total of 104% tariffs starting tomorrow, or in 2 days as it stands.
Go buy that phone.
What's that?
Go buy that phone.
You're right. I'm gonna go buy. You're in a situation like I saw this supplier on X last week saying, look, the 54% I source from China and I sell to big American companies, and right now my costs are going to go up 54, and my big companies aren't taking it, so I'm just going to shut down production. I can't take it, and so now it's 104%, not 54%. So either inflation's got to go up enormously at the consumer level. Or you're going to have this there is no business out there that can take 104 that's sourcing from China that can take 104% hit to their margins without massive layoffs, etc. So at a time when corporations need to refinance, to Louis' point, at a point where this is going to cut into tax receipts, which the U.S. government can't afford. So if I'm China, people are saying right now, well, we're going to push to China. They're going to devalue. We're going to force them to devalue, and then they'll break. If I'm China, I ain't devaluing anything. I'm going to sit here and I'm going to let them swing.
The old story of Napoleon saying to his officers, when the enemy makes a mistake, you don't interrupt them. So if you're China today, devaluing the renminbi would be essentially helping out the U.S. that's going to be dealing with an inflationary hit. So no, I don't think the renminbi is going to devalue. No, and again, I think, look, they're going to see how the U.S. wears this, how the U.S. wears the pain, and the reality. When you look at the Chinese leadership, they might not look and feel communist, but they were brought up in the Marxist church, and in the Marxist church, your catechism is that big shifts in history, revolutions, riots, etc., occur not because of individuals or ideas, but because of economic forces. And there is no more powerful economic force than inflation. And so this is why, the Chinese leadership are so paranoid about inflation at home. As soon as inflation steps up, they step on the gas, etc. They step on the brakes, and part of the catechism of the CCP is that when you look at Tiananmen in 1989, it wasn't that the kids wanted democracy or that the kids wanted freedom, etc. But it was that at the time, Chinese inflation was 20%. So in the CCP framework of things, you get double-digit inflation and bad things happen. And you get riots in the streets, etc. I'm not saying I buy into this Marxist ideology, but what I believe doesn't matter. They firmly believe it. And so, going back to the point that Luke made, if you listen to Scott Bessent and to Donald Trump and to J.D. Vance 3 months ago, the narrative was, we're going to do 20% tariffs, and half of that will be paid for by the rising US dollar anyway, right? The US dollar is going to go up on the back of the tariffs. And so the hit to the consumer will be very little. Meanwhile, the government will make more money. Perfect. Except it's not going that way. They're doing the tariffs, and the US dollar, instead of going up, is going down, which means that the inflationary impact of the tariffs will actually be double, because you're going to take the devaluation and you're going to take the tariffs. And I think that's why the bond market is not rallying, even though equities are down 18, 20%. If we'd all gotten together a month ago, and Ronnie, you would have told me, Louis, I can guarantee you, hand on heart, stocks are down 20% over the next month, I would have said, well, just load up on US Treasuries, you'll do great. Nothing.
And that's where, to your point about where inflation drives unrest, I think that's where we're seeing the unrest first in the US is in the bond market, which is, again, because they didn't devalue the debt first, they left broken ribs, not just exposed, but basically just standing there with your hands up over your head saying, hit me. And there it is. The riot, the protests, the riots are going to start in the bond market, but that's not where they're going to stop. It's just where we're seeing it first.
I think Trump really understands what the median voter wants. And I think inflation was a major concern, and then obviously also immigration, illegal immigration to the US. Now, listening to Trump, sometimes it reminds me of this Tolstoy quote. I've wrote it here. Tolstoy said, because of the self-confidence with which he had spoken, no one could tell whether what he said was very clever, or very stupid. So sometimes I'm really confused with reading the stuff that Stephen Mirren wrote, which is very, very interesting. Then listening to Scott Bessent, who's obviously a markets guy. Then also, listening to J.D. Vance, who made some very, very important points actually. And the Europeans were, I think, quite annoyed to hear those inconvenience truth. But then at some point, I also think, okay, what's actually what they're trying to orchestrate is pretty naive, because they think they can fine tune the not only the US economy but the global economy like a thermostat. It's a little bit more complex, I would say. So coming back to this Mar-a-Lago Accord. I mean, we wrote about the Plaza Accord and the Louvre Accord. Obviously, the Americans wanted to get the US dollar down, and then after the Plaza Accord, it went down big time. So they had to come up with the Louvre Accord, and it was a very, obviously there were discussions going on, but it seemed, at least in hindsight, that it was a very diplomatic kind of conversation where the other interests were respected. Now I can tell you, having the European viewpoint, I've never experienced so much let's even say hate and distrust against the United States. And I think quite a lot of this, let's say, trust capital that the United States have basically developed over the last couple of years, over the last couple of decades, seems to be eroding at the moment. So do you think that it's really realistic to come up with this sticks and carrots plan, and to say, okay, let's do a Mar-a-Lago Accord and we'll restructure the global economy based on what we, the Americans, want? Or isn't that, to me, it sounds a little bit naive and kind of out of this world.
I don't think that's going to happen. I don't think there's going to be the sit down. I would make the argument that that the tariffs may have been the Mar-a-Lago Accord, unilateral. In other words, like, I am increasingly coming around to the view that what happened on Wednesday was the Nixon Sunday night surprise. We closed the gold window on Sunday, August 15th, 1971. I think we just closed the dollar window on Wednesday, April 4th.
Luke, may I just jump in? Did you read the book 3 Days at Camp David?
I did.
And to me, I loved it. And people always think, okay, there was a big plan behind, very structured. But then actually, Nixon kind of made that up within a very short time. The TV recording and everything. And actually, it's a brilliant book that basically confirms that many of the things that are happening. Let's also mention and believe me, it will be enough quotes by Draghi. Those things are not actually planned. They just come out there. They're basically, there's no big plan behind. Would you say that with the tariff announcement, there's probably also not really a big plan behind? They just said, okay, let's give it a try.
I think there's one of two things. I think there is either a plan to try to sort of force people into it with tariffs is the preferred method. And I think the alternative method, which is really kind of scary, is, well, worst case, if no one will play ball, then we'll just burn down the whole thing, right? Okay, we'll start with this. Markets will crash. People will look for a bailout. The Europeans will want swap lines. No swap lines. If that still doesn't work to scare people out of American assets into gold, to start really devaluing the dollar, fine. Then, maybe American banks will start to fail. And when they start to fail, no bailouts for anybody over $250,000 deposit insurance. You got over 250, it's gone in an account. If that doesn't do it, then we'll just keep doing it until the world understands that we don't want this. Now, do I think it's the right thing to do? Do I think it's likely? It's not my base case. However, if you would have asked me 3 months ago, what are the odds the United States would stand aside and let the Treasury market dysfunction, and maybe even up to and including a Treasury auction failure, to achieve the longer term goal of basically shifting capital out of the U.S. to significantly weaken the dollar to try to achieve what they see as the end state, I would say there's zero chance of that. And I think it's still a tail risk. But I don't think it's a 0% risk for these types of extreme outcomes anymore, whether that be, we saw the Bloomberg article last week or 2 weeks ago. The ECB is no longer comfortable or sure that the U.S. will supply Fed swap lines. Like, what would the ECB do? Are you going to starve for lack of dollars, or are you more likely going to say, you know what, we're going to bring gold collateral in, we're going to start bidding it, and we're going to reliquify using that? And the dollar would probably fall on that, I would think, at least relative to gold, which I think is ultimately what we're trying to do, is create gold as this neutral reserve asset, to devalue the dollar against gold as the pivot. I think those are the types of things we could see let me put it. I think it is no longer impossible that is what is being attempted here by this administration, because otherwise, if I don't think along that line, what they're doing makes less than 0 sense to me.
So I'll jump in as well. look, I was a big proponent of the Mar-a-Lago Accord. I was a big believer in it. I wrote pieces. I said one of the reasons I was a big believer in it was that Scott Bessent himself kept talking about it, and I thought, okay, here's the narrative. They're going to come in, they're going to sit down, they're going to use tariff as a tool to threaten China, Japan, Korea, etc. And they're going to sit them down, and they're going to say, "Oh, you guys have way undervalued currencies," which they do. You need to revalue your currency. You need to buy a bunch of U.S. Treasuries and help us get the bond yield down. And you need to build more factories in the U.S. so that I can come in and with a big pair of scissors cut the ribbon, and it looks like I'm dealing with the problem. And this is how it's going to go. I was a firm believer that we were heading this way. And I deep down, I still think that was their goal. That's where they wanted to end up. That's where they wanted to end up. Again, having China buy more treasuries, having BYD open factories in the U.S., having higher RMB. That was the goal. And I think that the process has now thrown them way off course. Because the whole tariffs of let's blanket tariffs on everybody and their penguin. Let's rub Xi Jinping's nose in it. Then you leave him no options. So I think that the process, I think that was the goal, but the process of how it was managed mean that now it's not going to happen. Now, having said that, the U.S. can still bully Japan and Korea to do whatever they want. That's the premise. That's the whole privilege when you have troops in another guy's country. At the end of the day, the guy's got to do what he's told. So I still think you will see the higher Japanese yen. I still think that Japan will be buying more treasuries, etc. Same with Korea. But I think with China now, it's gone. China now, after today, I think it's too far gone. And for me, the big question is, out of this, is it the U.S. that ends up being isolated, or is it China that ends up being isolated? And that's the big question mark. If it's the U.S. that ends up being isolated, then I think the treasury market melts down. If it's China that ends up being isolated, obviously it's terrible news for Chinese equities, but they're cheap anyway, and and I think the government will probably intervene at some point to just buy the market and crank it back up. Because it's cheap enough and they can do it. So this is now the question mark. And I guess, Europe, other big emerging markets will have to decide, what, I'm siding with China on this one because, the US is really pushing the envelope. Or even if the US is pushing the envelope, China remains a totalitarian country, so I can't side with them. So I still have to side with the US, even though if I have to hold my nose in doing it.
One very important thing that I want to your opinion, both of your opinion, please, on is the question. Okay, if the treasury market melts down, there's this. Luke, you talked about the ECB, right? We both love the ECB. So the ECB is scared shitless of stablecoins. Right, they talk about the digital euro every day. Bessent goes out and says we're gonna the US dollar is gonna be the state reserve currency of the world, and we're gonna use stable coins to do it. What is in there? Are they really gonna do that? Are we gonna go free banking on crypto and just anybody who wants can print some dollars and buy some treasuries, and that's the way forward? Or is that just some other sideshow that gets blown out of proportion?
This is another one where in November, even in, third quarter of last year into November, it seemed to be really sort of a credible way to find balance sheet capacity to manage the treasury market, which was through stablecoins. Hey, if we grow the size of crypto, we grow the size of the stablecoin market, and we grow the size of Bitcoin really, because it's Bitcoin goes up, stablecoin market goes up, stablecoins we regulate into buying T-bills. Like, hey, this is a way where we can find, depending how much Bitcoin goes up and how much we regulate, in terms of reserves that these stable coins have to own in T-bills, hundreds of billions, if not, $1 trillion in balance sheet capacity at the front end of the curve at a time when the United States desperately needs balance sheet capacity. And so initially, all this made a lot of sense to me. And since then, it's kind of devolving a bit because you've got Bessent saying we're going to keep the dollar reserve currency through this. Great. Okay. And the world is going to move into dollar-based stablecoins. Okay, great. But the only way that that's going to happen is if the U.S. keeps running deficits to get dollars elsewhere, I would think. So that doesn't make sense to me in terms of there being a real growth in stablecoins, dollar stablecoins, with which to flow back into treasuries. And then in addition, when you look at the legislation, it all still has to abide by know your customer and AML and sort of all this through the U.S. banking system. And so what to me started to look like a credible way to find a lot of balance sheet in relatively short order to deal with the worsening U.S. fiscal problem that was good for Bitcoin is starting to look like a money grab by the big U.S. banks who are starting to sort of crap their pants that stablecoins are eating their lunch. They're looking at Tether going, this guy's got 200 billion or whatever it is, 120 billion sitting in T-bills making 4.5% with no cost. Like he's literally making, nearly as much money as all of JP Morgan is with like 30 people sitting in Switzerland. And as this happens on smartphones around the world, they're going to eat our lunch. And so we want to Americanize and get control of this under the American financial system, which, fine, I don't really care. But then again, these are contradictory goals, like so much else of what this administration is trying to do. Do you want to internationalize the dollar? Okay, well, how are you going to do that if you're not running the deficits, which the other side of your policy is doing? And if you wanted to expand a lot, then you're going to have to sort of look the other way on a lot of AML kind of stuff, but you don't want to do that. So like, to me, it just feels a little bit like a word salad of like trying to sort of cover everything while not achieving anything.
Louis, any thoughts on stable coins, or should we come to the final question?
Let's go to the final question. I think Luke said it all.
Okay, so Kierkegaard, I think he said that life can only be understood backwards, but it has to be lived forwards. And let's say, okay, because in this In Gold We Trust report, and I can tell you, writing 400 pages about gold these days is it's not the easiest task, but we're quite used to having short-term turmoil that affects the price of gold. But let's say, okay, we've got, like Marty McFly, we've got this DeLorean in Back to the Future. So let's say it's April 7th, 2030, and we're basically peering back in time through our DeLorean windshield. So with the knowledge from the future, what would you have bought on April 7th, 2025, and why? Would it be, I think I know Louis' answer already. Would it be emerging market related? Would it be commodity related? What kind of currency? And then would you say in hindsight that this Liberation Day was actually, it was just a short-term blip, or was it really something that will go down in history books?
I think it's a game changer, actually. I think it's a game changer. But I think a lot of what the Trump administration has done in the past 3 months since coming in have been game changer. Essentially, Trump is signaling that, look, the age of U.S. empire is over. He's saying, we're moving back into our own borders. We're going to build Fortress America. Maybe you can call it Fort Monroe. And Greenland, Canada, come inside. We'll get the Panama Canal back. But essentially, these are now our borders. It's the Western Hemisphere. And Europe, you can do your own thing. Asia, you can do your own thing. But we're essentially folding back. And I think they're doing this for a number of reasons. One of them, actually, I want to give Luke credit. He highlighted to me Eric Prince's speech at Hillsdale College, which for me is I reread it 3 times. It's earth-shattering. Essentially, Eric Prince's message in that speech is the primacy of U.S. weapons is over. That we put in all our best weapons in Ukraine, and Russia basically figured out how to counter them. Now, that may or may not be true. Maybe we believe Eric Prince, maybe we don't. It doesn't really matter whether any of us think this is true. What matters is Eric Prince is very close to President Trump. So he's passing on that message to President Trump saying, hey, look, U.S. weapons, you used to think, we were 3 generations ahead. We're not. We're not. The other team has hypersonic missiles. It's got drones that can swarm us. Warfare has changed and we're no longer sure to win. So if you're given that message, if you're President Trump and you receive that message, you can choose to discard it. But if you think, I respect this guy, he's the best warrior of his generation. He's a former Navy SEAL. He's created Blackwater. He knows what he's talking about. And unlike all the U.S. generals, he's not going to BS me. If that's the case, then yes, I'm going to go back to be defended by my 2 beautiful oceans, as he puts it, and essentially fold back onto the United States, which is exactly what they're doing. J.D. Vance's speech in Munich was exactly that. It was telling Europe, look, we're folding back. And he did it in a way where he said, logically, he should have said, it's not you, it's us. But he essentially said, I'm breaking up with you and it's you, it's not me, it's you. You're a terrible person. That was J.D. Vance's breakup speech in Munich, which was a little, being broken up with is hard, but usually the other guy has the decency to say it's not you, it's me. It's like, but J.D. Vance didn't even have that decency. He just said, no, it's not me. I'm great. You suck. That's why I'm breaking up with you. Anyway, so they folded back. The U.S. is folding back onto its own borders, which is why I think, in this whole question we're having, is China, is it going to be China that's isolated or the U.S. that's going to be isolated? If you're Thailand today, if you're Malaysia, if you're Indonesia, even frankly, if you're Japan or Korea, and you see this U.S. folding back, you're like, maybe I don't want to piss off China as the U.S. folds back. I may want to be close to China. Anyway, bottom line for me is when I look at this, the more obvious trend for the coming years is a weaker US dollar. And then from there, what do you buy when the US dollar goes down? Now, my own bias when the US dollar goes down is I buy emerging markets. I buy especially emerging market financials because when the US dollar goes down, EM central banks can let loose. They have no more constraints. And so you tend to have pretty loose monetary policy, loose lending criteria. So EM banks tend to thrive when the US dollar is down. So I think today you buy the EMs, you buy EM banks, you buy commodities, you buy all the things that will go down, that will historically do well when the US dollar goes down. And there's a lot of them. You can build a diversified portfolio between a lot of these asset classes.
Luke, we're in 2030 and you're going back 5 years. What would you have bought?
Yeah, I would obviously add gold and Bitcoin to those things. And then I think, something I've been harping on, U.S. electrical infrastructure and things that touch it. It is, we are so behind. There is so much investment to be done. I keep hearing, a private company I'm involved with, one of the execs told me a few months ago, like, look, our big suppliers, sort of, the Japanese multinationals of the world are telling us, look, next 3 years, we think business is going to at least double in the U.S., at least. But we're not telling anyone anything near that because what's our upside in doing so? And Trump, this was before Trump's election. And if anything, that timeline has probably only gotten more aggressive faster. So I think U.S. domestic electrical infrastructure industry, I'd be looking at different sort of higher end U.S. agricultural properties. I think at some point are some of the things I would be most interested in.
Great, thank you very much, Niko. For you, it's probably Bitcoin. It's fairly easy.
Thank you. I said it's either going to be Bitcoin or if I could afford a farm in Argentina. But I can buy 1/1,000,000th of a Bitcoin. I cannot buy 1/1,000,000th of a farm in Argentina. So I'm going to go with the Bitcoin.
So, gentlemen, this has been great. Thank you very much for your time. We will feature this in the In Gold We Trust report. as I've said, we're subscribers to your research services. So there's now plenty of time for shameless advertising. Where can we find you? Where can we learn more about your companies, your services? Let us know.
For me, fftt-llc.com for more information about mass market or institutional research offerings.
Thanks. Yeah, for me, the best place is gavekal.com, GAVEKAL.com. Our website has all our various offerings for different types of clients.
You're both also on Twitter or on X. Also great follow. Gentlemen, thank you very, very much for taking the time. It's been a true pleasure. This will be one of the highlights of this year's In Gold We Trust report. Thank you. Be good, be safe, and we truly look forward to talking to you soon again. Thank you very much.